And welcome everyone to today's keynote on lithium. My name is Koby Kushner, I'm a mining analyst, and I'm going to discuss where I see the biggest opportunities in the lithium space today. For disclosure purposes, these opinions are my own, do not necessarily reflect the opinions of my employer. Lots of you might disagree with my opinions, and I openly welcome that. Next slide. Okay. So if you're here, you've probably at least heard about what's been going on in the sector. Prices have, of course, exploded. Lithium miners are turning record profits. The elephant in this room is this recent 30% dip from the top. But to be honest, prices could drop another 30%, and I'd still be laughing because miners will still be producing at margins basically unheard of in any other metal right now. So in gold, you'd be in a good position to be selling an ounce for double the cost to get out of the ground. In lithium, you're selling it anywhere between 5 to 10 times the cost per ton, give or take. So despite the recent dip, prices are still high, and we're still very disconnected from the cost curve. And I don't think we're going to be seeing prices trickle all the way back down for the foreseeable future, as long as there's more buyers than sellers. Slide. So here's benchmarks, supply, demand graph. Sorry, this is the demand graph. So just a little bit of a story here on lithium. So taking a step back in time, lithium is very new in terms of its newest demand driver, which is batteries. So the first lithium-ion battery was commercialized in 1991. 2018 was an inflection point. That was the year when battery demand actually overtook industrial demand. And 2021 saw passenger plug-in EVs start to dominate lithium demand. Slide. So one possible threat to high prices of any commodity is demand destruction and substitution. But lithium differs from other battery metals like cobalt or nickel, and that's because it's constant in all major cathode chemistries, including NMC, LCO, LFP, and there's a reason for that. So lithium's number 3 on the periodic table. It's the smallest, lightest metal in existence. Its size allows it to pass through the electrolyte of a battery. It's got an unstable valence electron that just wants to jump away from the atom. It's a great conductor. But because it's the lightest metal, it also allows for superior energy density. So non-lithium battery chemistries simply lack this energy density, making them impractical for anything designed to move. Vanadium redox flow batteries, for example, are very promising for stationary energy storage, but they're the size of the stage that I'm standing on. So it's not something you strap onto an EV, let alone put into your cell phone. Next slide. So this is benchmark supply-demand graph. They break down supply based on existing operations, probable and possible additional tons from other mines if they come on. So the demand line is on the top, clearly growing faster than supply. Something to note that these demand numbers aren't based on unrealistic government decarbonization goals. It's based on demand straight from the Gigafactory pipeline. So last year we saw an overall deficit. It's looking like we might see a small surplus this year on an LCE basis. But then go back into deficit, and then things will get really bad into the 2030s. So we'll need over 70 average-sized lithium mines to enter production to keep up, but right now we are running out of reserves. One issue is that it takes longer to build a new mine than it does to bring on new battery capacity, and hence this deficit keeps widening. Next slide. So here's the takeaways thus far. Lithium demand isn't going anywhere. The risk of engineering it out of a battery in my view, is very low and unlikely. The only thing that would cause prices to snap back would be the introduction of new supply, which we haven't seen enough of yet. Having a resource bottleneck wouldn't remove EV adoption, it would simply slow it down, which would only prolong high prices. Some of the new supplies coming online also come in at a higher cost, right? So this would push the cost curve up, so even if prices do come down, it's still likely well above historic norms. So the bottom line is that this bull run is just getting started. The question becomes how to capitalize on it. And the best way to do that is to look for opportunities that are most likely to throw a wrench into the supply problem. and there's two things that come to mind. First is grassroots lithium exploration, particularly from hard rock sources, and then unconventional sources of lithium, like clays or DLE brines. And neither of these things have really been done before. Slide. So we're going to start off with grassroots exploration here. Today's dominant producing operations didn't actually start out with lithium, right? Greenbushes was originally tin and then a tantalum mine. The Atacama was originally a potassium producer. So lithium as a byproduct was enough to cover industrial demand. But with battery demand being a brand new driver, there's finally an incentive to explore for lithium. So meanwhile, metals like gold and copper have been explored for millennia, and this chart shows exploration budgets by year for some other metals. So lithium is in red at the very bottom there. We've got nickel, copper, and gold. So it sounds contrary to what appears to be happening in today's market, but relative to these other metals, lithium exploration is actually underfunded. It's particularly interesting that there's still more money being allocated to nickel exploration. Nothing against nickel, we need more of it. But we have to keep in mind that we still need more new lithium mines than we do new nickel mines. But this also speaks to the scarcity of quality lithium projects upon which to allocate exploration dollars to. So perhaps there's just not enough lithium projects out there that are drill ready and warrant the big exploration spend. Slide. So this is the same chart as before, just zoomed in only on lithium. Grassroots is the deep red at the very top of this bar chart here. Historically, most dollars were spent on more advanced assets, but the way to find more deposits, of course, is to spend on grassroots exploration. But the way we find, so historically, grassroots exploration did not really occur because there was no need for it. Even the exploration that we saw in the previous cycle, a lot of that was focused on known salars and historically mapped lithium pegmatite occurrences. In Australia and Canada, we're seeing a lot of gold companies pivot over to lithium. Some companies more so saying, hey, by the way, we have lithium potential. Next slide. So this is my favorite example here. This is Patriot Battery Metals' Corvette project. Corvette was a gold project. This photo is from one of the pegmatite outcrops at Corvette. Years back, Virginia Gold Mines had this property, and while mapping, a geologist was probably having their lunch on this pegmatite, noted some spodumene, and continued on with the search for gold. So lithium was known about here for years. Patriot didn't actually discover it, but they were the first to drill it off. The Tanko mine in Manitoba is another example. They were chasing tin anomalies, and they hit a lithium, cesium, and tantalum deposit. So up till now, there was no real concerted effort to go out and look for new lithium pegmatites. If the existing deposits were mostly found by accident, then imagine the discoveries that could be made if we deliberately looked for lithium. Next slide. Whenever anything gets hot, whether that's lithium, cannabis, or crypto, it attracts the pumpy-dumpy promoter types. And there's a lot of straight-up moose pasture being staked and marketed to the investor to put into their pumpy vehicles. So it's wise to read up a bit on the geology, starting with the pegmatites. So lithium comes from pegmatites, but most pegmatites do not have lithium. So when a company says, hey, we have historically mapped pegmatites, know that that alone does not mean much. Lithium occurs in the LCT type of pegmatite. Pegmatites are offshoots from a granite body of rock. So that's that pink blob at the bottom of the screen there. And then there's these smaller blobs just immediately above it, and these are the pegmatites here. So during a continental collision, the granite will melt into the host rock. What's key is that lithium mineralization is spatially related to this granite. So as you get further away, your pegmatites become more and more complex. Generally, there's a sweet spot, or this Goldilocks zone, usually about 4 kilometers away, but it can range, where conditions are just right for lithium mineralization. Very rarely will you find lithium-bearing pegmatites inside the granite itself. There are, of course, exceptions. Next slide. After any major discovery, area plays begin to emerge. So this is, again, Patriot's Corvette project. What's not shown here is that everything is staked within a 20-kilometer radius. The deep blue lines show where the actual Corvette or the CV pegmatite trend is. It's hosted entirely in these greenstone rocks that trend east-west. Patriot has basically that belt locked up. Most of the area plays are entirely in the granites close by, but wrong rocks. So closeology does not necessarily mean prospectivity. There's a lot of other things to look out for. Companies talking about lake sediment anomalies, for example. There's a chance that those anomalies came from clays carried over by glaciers. It might not actually indicate that there's spodumene nearby or on the property. So I'm not saying that area plays are bad. I'm not saying that lake sediment data is bad, or that pivoting to lithium from gold is bad. I'm just saying that there's a lot of crap out there in the lithium space. And now more than ever, investors need to be cautious. Next slide. So moving on to the other opportunity, which is unconventional sources of lithium. So that's clays, oil field brines, geothermal brines. So like grassroots exploration, lithium extraction from these sources hasn't really been done at a large scale. But if enough of these come online, this can potentially solve our supply problem. Next slide. So starting with the clays, so sedimentary deposits, which include clays, represents a third source of lithium, with the first two being brines and pegmatites. These deposits can be massive, represent some of the biggest lithium resources in the world. The geology is usually consistent. You can get a measured resource with 200-meter drill spacings, and they're relatively easy to delineate. I've seen resource updates where each new hole added over 300,000 tons of LCE. It is yet to be extracted on a commercial scale. The closest we've seen was the Bacanora project in Mexico, which was producing battery-grade lithium carbonate at the pilot level when Ganfeng Lithium bought it, but then Mexico decided to nationalize lithium. So we're seeing other major players putting more and more faith into these deposits, and for the first time ever, they are getting funded for construction. Whether they are successful in their ramp-up remains to be determined. Next slide. So I want to touch on DLE, or direct lithium extraction. So traditional evaporation brines, like what we see in South America, work by pumping lithium brine from the salt lakes and storing them in evaporation ponds and letting the sun do its work. You need to start off with a high-grade brine, or else the process will just take way too long. You also need a large footprint for these ponds. Recoveries are usually mediocre, and the process takes months. You also need to be in a desert. So this is where DLE comes into play, which may allow for the recovery of lithium from brine without evaporation. Right now, the only commercial DLE brines operating are doing so in conjunction with evaporation, to my knowledge, although I'm hearing stuff at a Sunresin in China claiming that they are doing it purely, but I'm not sure. A lot of these companies are now, of course, focused on building pure play DLE brine operations. So, to describe it simply, it's kind of like a filter. Usually uses a solid membrane or resin that sticks to the lithium. The brine goes through this filter, and out comes a lithium void brine, and then you strip the filter of its lithium. Of course, the process is a lot more nuanced than that. For one, it's not so much a physical reaction usually. But it has several benefits: higher and faster recoveries, a smaller footprint, and importantly, it can unlock brines that are not amenable to evaporation. This includes lower grade brines and brines not located in a desert. So if there's one technology that I think has the best shot at throwing a wrench into the whole lithium supply gap issue, I think it's DLE. And I'll explain why. So next slide. So not to dive deep into the weeds here, but it's important to know that DLE isn't a single process. There's different types of DLE. None of the three processes shown here are new. Ion exchange has been around for decades. It's what's used in ISR uranium mining, and it's also used to soften your water. What is proprietary for some of these DLE technology companies isn't the process, it's the material that they've developed, or the filter, if you will, that has a high affinity for lithium and only lithium. So there's actually more DLE technology companies out there right now than there are DLE resource developers. A couple things to note: it's not a one-size-fits-all solution. Because each brine chemistry varies, the DLE technology needs to vary as well. Also, not all brines are necessarily amenable to DLE. Companies that say, oh, well, we'll just use DLE act like it's some guaranteed fallback for them. DLE technology today tends to favor very consistent brine chemistries. So if your brine chemistry is highly variable, then your DLE would need to vary as well, which would be impractical from an operating standpoint. Next slide. So when dealing with evaporation brines, you need to start off with high-grade brine, or else the process takes too long in order to get your high-grade concentrate. With DLE, you don't have to worry about that. What I've found is that deliverability, or the flow rates that you can get per well, that plays into your economics more so than grade. So you can get the highest grade brine in the world, but if your flow rates are low, you're going to have to drill way more wells in order to produce any meaningful quantity of lithium. And at $3 million, give or take a well, that can really blow out your CapEx. So when calculating a resource, DLE companies may use a cutoff porosity rather than a cutoff grade. I tend to trust oil and gas people more so than mining people when it comes to this stuff. See, mining tends to focus on grade, whereas oil and gas focuses on fluid flow. So I mentioned that existing producers should be fearful of DLE, and the reason for that is because if this thing works, then DLE producers will probably have an easier time scaling up lithium production. So looking at hard rock projects, generally your production rate is limited by the geometry of your ore body. With evaporation, you're limited by your evaporation rates. So DLE removes these bottlenecks. Scaling up production could simply be a function of drilling more wells. Next slide. So to close things off here, here are 4 trends that I see persisting into 2023 and likely beyond. So first is increased nationalization. Most countries do not have domestic production, and they're worried about having to rely on others. Last year, we saw Mexico nationalize lithium, Zimbabwe ban its exports, and Canada forcing Chinese divestment from 3 lithium juniors. I expect this trend to continue. We also saw the US and Canada start providing incentives, critical minerals flow through, for example. So I'm also cautiously optimistic that countries will start to remove some of the red tape and hopefully speed up the timeline to get permits. Compared to the previous lithium cycle, this time around we are seeing a lot more automakers involved, signing offtakes directly with the producers and now funding mine construction. Soon enough, automakers might actually own the mining companies. We expect M&A to continue, especially in exploration. There's just way too many companies doing the same thing at the same place. And there's a general lack of lithium expertise, so consolidating for the purpose of bringing on talent makes sense. I'm not sure if consolidation will catch up with the number of new lithium companies that will pop up. That means a lot more investment into exploration, into DLE, and more discoveries. And where there's money being thrown, there will be more lifestyle companies there to catch it. So invest carefully, do your DD, and thank you for listening. I will now take questions.